Welcome to Capitalizing Your Life, the podcast that shows you how to take control of your money, build lasting wealth, and create financial freedom using the infinite banking concept. If you're ready to make your cash flow work for you instead of someone else, you're in the right place. Here's your host, Glenn Yaney.
Welcome to Capitalizing Your Life podcast. I'm your host, Glenn Yaney. Today, my guest is Nick Kosko with Breakaway Wealth.
What's up, man? It's a pleasure to be on. It's been awesome getting to know you the last year and a half and been walking along a journey together, man. It's awesome. So thanks for having me on here.
Yeah, we've had Nick on the Millionaire Journey. And then since we've rebranded the podcast, now I work with Nick Kosko. He's part of my team that we work together, me and Nick and Jim. And we had Jim on previous podcast. And this is probably 101 or 102 episode. So
Awesome.
Yeah, so today I told Nick that we just go over a few things. Always the best to go through the book of Becoming Your Own Banker, and there's the 5 principles of Nelson Nash, and we're just going to go through each one and how it pertains to IBC and finances.
Yeah, man. It's just like we always go back to the basics, right? Like people want to make this way more complicated than it is. You know, there's a John Wooden, the famous basketball coach at UCLA back in the 70s. Every season he started with teaching his players, Lou Alcindor, right? Bill Walton, but he taught them how to put on their shoes and socks, right? Like the proper way to do it. So like you brought me an idea and it was, hey, let's just talk about Nelson's principles, right? Like some people see Nelson's book, Becoming Your Own Banker, and they go, that's just written by this old kook. Yeah, cute, right? There's some really old books that are still true, right? And it's really amazing the lessons, people put newfangled marketing spins on this subject matter, but the reality of it is it's all rooted in Nelson's messaging. Some people hat tip to it, some people don't. Some people like to say, oh, I was taught by Nelson, and be like, how long you been in this? Oh, I got into this in 2022. Well, that's funny. Nelson passed away in 2019.
Yeah.
I love, I've sat and had dinner with a man multiple times and he just would come back to the basics. Who's in control, right? So I love that you brought to the table, hey, let's just talk about Nelson's principles. Some people say there's 4. Some people say there's 5. I remember we were talking about this before we started. I remember he had this slide and he had 4 of them on there, but we did a little homework. I can't find that slide of his. It's somewhere in our drive. I've got his slide deck, but it says there's 5. And I think what it did, it took the first one and the 5th one and basically made it 2 instead of a set of 1. So let's dive into them, Glenn, because man, just keep it to the basics. When you're trying to understand what it looks like to be the owner of your financial world instead of just being the renter or the customer, let's just go back to the basics here.
Yeah, definitely. And talking about Nelson is, I really, when I first started talking to Nick, I'm like, man, this guy talks about Nelson a lot. And I would, there's a lot of content with Nelson in it. And at first you're like, just the Southern twang and all these long stories where you have no idea where they're going, and then he gets the hook at the end. But I can tell you that I've read so many more. I've read his book a few times now. The one I really enjoyed recently was what was it? The Wealth Warehouse.
Building Your Warehouse of Wealth.
Building Your Warehouse of Wealth. Yeah. So I'm like pretty much my second time reading that one right now.
Yeah.
And I'm like, man, this guy just had it down. And the more I read of his stuff, the more I just like everything he's like on point. So
Yeah.
Let's get into these 5 principles of IBC. The first one is think long term. If you could elaborate.
Hey, so Glenn, if we were going to run a race, do you want to start first or finish first?
I want to finish first.
That's right. But you can't do both, right? Watch some videos of Usain Bolt, right? It's amazing. That cat is not the fastest out of the blocks, but he'll be 8 feet past the second place guy, right? By the time they do 100 meters. And that's all Nelson was saying. He's like, listen, you can trick this thing out. Well, look at these people that do 80-20 and 90-10 policies, right? Looks really cute at the beginning. If we're going to go checking account, we're going to go 90-10 policy, or we're going to go 60-40. All right. I know that's a little over some people's heads already, but just, it's the way we design the policy, right? The checking account wins. Why even do a 90-10 policy or an 80-20 policy? It's kind of almost pointless. Just stay with your checking account, right? Because you're cutting your nose off. But if we're going to really do it like Nelson taught us to do it, I'm not the smartest guy. I don't know. I don't know about you, but I didn't invent any of the ideas that I do, right? Like I had to trust somebody else.
Yeah.
And so Nelson, if you walk through his book, like it's very thoughtful what he did. It's only 92 pages. He would tell you he could have written a 200-page book, but every one of his examples is within a couple percentage points of 60/40 policy design. Why is that? Because it struck a great balance between having cash value at the beginning and having amazing efficiency long term. So we had to think long term, like we're solving a problem that you have this need for finance. Glenn, when are you going to stop spending money?
Always going to spend money.
The day you die. Actuarially, you've got 50-ish more years to spend money. So that's an opportunity. It's an invitation to solve this problem for 50 years. And what do people do? They get all mired in the first year or two of the policy construction.
Yeah.
Okay, that's great and all, but let's look out at long range. So we have this opportunity to solve this need for finance for 50 plus years in your life, right? That's on the short end. So like with technology, you may live 60, 70 more years, right? So he's just saying, hey, listen, you've been doing it this incorrect way for 30 plus years, right? Like you've been the customer of the bank. Like you're not going to snap your fingers and solve the entirety of the problem in year one. He even says, hey, listen, you could probably get all your premiums, your income to match your premiums, and take over the entirety of the banking function in your life in roughly 11 years. That's a long time to some people, but I can tell you what, I've been doing this longer than 11 years. And it seems like just yesterday that I got Nelson on the phone and said, nobody in the state of Kentucky certified to teach this. I want to be your guy. And here we are 12 years later, 13 years later, and we're still learning, right? We're still refining our messaging. I'm still looking to expand my system, do my system better, right? It's a long game.
Yeah, it definitely reminds me of when I've had a few panic texts to you about, when I signed my policy with you, I could tell that you were thinking long term. Like, that was the one thing I was like, he's not I knew it wasn't about, like, yeah, the cash value is important at the beginning, but it's not the whole thing. But
Yeah.
whenever I started doing more research and I started reading into books like How to Buy Life Insurance, which is very in depth, I started panic texting Nick to find out. I'm like, hey, did I structure my policy correctly? And I was like, is it a 1090 or was it a 60/40? And you're like, it was a 60/40. So it was one of those things that I really appreciated whenever I was like, man, I'm glad I picked Nick over this one just because of
Thanks.
at that time I'm also, the longer I look at this, the more I understand like how important it is to be able to have a long play for these for the
Yeah.
policies. So
Yeah. And we got to think like our culture is telling us, I'm actually sympathetic to people feeling short term minded. Our culture teaches us, what about today? Right. But that message is not working. Only the dead fish go with the flow. Right. So,
yeah,
the flow is, what can you do for me today? But that's not real life. And so it's being very intentional. It requires intentionality. It requires us to, and I appreciate our culture shifting a little bit too. Like people are turning off particular messaging. They're starting to realize, hey, wait a second, there's a lot of noise here. And so like we are teaching you how to recognize signal amongst the noise. And you were a sponge with that. You still are. I am. Like I practice that every day. So you want to jump in number 2 there?
yeah. So it's don't be afraid to capitalize.
Question for you, Glenn. Is there a check that you would write to yourself and take to the bank that would be too big for the bank to receive?
No,
So why would you be afraid that? But you would write that check and take it to a bank that you don't even own. What about a bank that you do own? Is there a check too big?
I try to write the biggest one I can.
Yeah. So that's where you were like, hey, I want to do X amount of premium. I know now that's a stretch for you. Like that made you were uncomfortable with that number.
Yeah,
You were comfortably uncomfortable with that number that you started your policy with, right?
enough to make you sweat.
Yeah. And if you could, would you have written a bigger check?
I think I'm pretty good with the one I wrote.
Yeah.
I'm looking forward to the future ones though, the bigger
Yeah,
ones.
there you go. You have the ability. We're creating a vault. So whether you're making 100,000 now a year or you're making 10 million or more, We want to be able to take and put all of that money into our vault, not a policy or not a bank account that someone else owns, right? It's because so if we're thinking about this from an ownership perspective, the more money that I put in my banking system, the bigger the pool of money I have to go put it to work. Because is the loan the asset or a liability?
Depends on who the loan's to.
The asset. It's an asset.
It's an
To the
asset.
bank, the loan is always an asset.
Yeah.
Okay. Because there's going to be interest charged. Well, if I'm the owner of the bank, I'm going to collect that interest and my pool of money is going to get bigger and bigger and bigger. Right. That's why, like, is there more than one McDonald's in your neighborhood?
There's a lot.
There's a lot. How many Publix are around Tampa?
There's 5 within 5 miles.
That's right. Well, why is that? Because they understand the bigger they make it, the more rows of peas, which we're going to get to that in the next one, they get to turn, right?
So
let's jump into that one. What the heck?
Real quick on don't be afraid to capitalize. And the way I kind of interpreted it is just because you have cash value in your policy doesn't necessarily mean you have to use it right away. And for me, having some liquidity is extremely important when it comes to, finding good deals. Is like the bigger, like sometimes like for us, like when I'm looking for a mobile home deal,
Yeah.
it's like, do I want to buy a 3 unit or do I want to buy a 20 unit or, something like that? And the problem is if you don't capitalize, you're going to be buying 3 units all day long. And if you capitalize correctly, you'll be able to buy a bigger unit count. So obviously there's a time to buy the 3 unit. My first park was a 3 unit, but now we're like, there's a limit to what I want to buy. I don't want to continuously buy single family homes all day. I want to buy, 20 unit parks.
Yeah.
To really grow my system. And I could tell you that when I was working at my W-2 job, putting all my money in my 401k, I would always said, like, I actually came across really good deals and I just had to find somebody to go buy it. Like, I was like, I need to get somebody to buy this deal that has the money because they have the capital. So I had to go run around finding that person and convince them that it was a good deal. Hindsight, they ended up not buying it. It was a 16 unit mobile home park, I remember. And he didn't buy it, but I definitely know it doubled in price within a short period of time. And that was because I was unable to capitalize, even though I might have had my money in my 401k or I paid off my house or something like that. It was like I needed to be able to be liquid enough to be able to take an action is really what it came down to.
Yeah, it's opportunity. Every dollar is a little worker waiting to be deployed.
Yep.
Right? And we capitalize our systems and have them there for emergencies and opportunities. And whatever those opportunities are that appeal to you, it could be you own a trucking company. It could be that you only buy mobile home parks. It could be that you buy only 100-unit complexes. Like whatever that is, but we got to think like the banker. The most important department is the lending department. They're evaluating deals all the time, right? And I think that if we can just have that mindset as the owner that we need to put those dollars to work for us, immediately could be tomorrow or it could be 18 months from now. It's all relative.
Hey guys, if you'd like to learn more about the infinite banking concept and how to flow your capital through your own financing system, my team and I are here to help. With over 35 years of experience, we can guide you in building a properly structured whole life policy tailored to you and your family. See the scheduling link below. Now, back to the show. So once you find the deal, you take the money out of your policy. The goal after that would be to not steal the peas. So that would be principle number 3.
Don't steal the peas. Okay, so if you own a grocery store and I own a grocery store, which one are you going to shop at?
I'm going to go to my grocery store.
Okay. Now, are you going to fill your bass cart and go out the back door and steal all those groceries, or are you going to go through the front door and pay for your groceries?
I'm going to go through my front door.
That's right.
Through the front door.
So tell me more about that math that Nelson talked about in his book.
I'll let you elaborate where you're going with that.
All right, sorry. So I think it's 57 cents. Okay. So each can of peas was 57 cents in his example, or it's 50 something cents. The grocery store only makes like 6 cents per can of peas. So if you steal a can of peas, you got to go sell 8 or 9 more just to make up for the cost of the one. Okay. And that's what he's saying. It's like the business owner, the amateur business owner always thinks about it like, oh, I get free service, or, the lawn care company. Like these guys are going to come here and I'm not going to pay for the service. But the reality of it is, if you paid for the groceries, go back to the capitalization. Now there's money back in there for you to buy more cans of peas, for you to make more loans. Okay. So if every can of peas that makes 6 cents, that's every business works on a turn, right? So that's why the guy's always going down the aisle fronting the cans, right? They want it to the front so that people can easily grab it.
Yep.
So that front spot on the shelf is where they want the can to go, and they want to turn that as fast as humanly possible. Every business works on a turn. Okay. Now, what people don't realize is they're the customer of the bank right now, and the bank's doing the same thing. That velocity of money. So, Glenn, when you make a payment to the bank on a loan, what do they do with that payment?
They try to lend it back out.
They lend it right back out. And if they got a lending department worth a darn, they got your payment lent before you even make it.
Yeah.
Okay. That's velocity of money. Okay. So we want to do the same thing. All right. And we get the privilege of doing that. So people will go, well, wait a second. Why do I got to pay interest to this insurance company? All right. Who owns the mutual insurance company?
The policyholders.
Only the policyholders. Okay. So let's go back to the grocery store. So now what we're doing, you're shopping for money at a financial institution that you have ownership and control of. Do you want to steal that money, not pay any interest, or do you want to pay interest to the system?
You want to pay it interest for sure.
Yeah. And Nelson walks through in page 72, I think, of his book, 70, 71, 72. It's right there. He shows where ultimately you wind up getting the interest back through interest dividends and the death benefit that is ultimately paid tax-free to your estate. Okay. Nothing leaves the system.
So real quick on that, because that was something that I kind of I didn't really understand until I had a policy. It was that when people say your money is being used in two places, this is kind of the line that you hear a lot.
Yeah.
So what they're saying is that you put in your money into you pay the premium and then you get cash value. The cash value has a guaranteed growth rate.
Yep.
And then they also have a dividend.
Yep.
So what you end up doing is you borrow against that cash value so it's a line of credit that you're actually from the insurance company that you're going to be investing.
Yeah.
So while that cash value is in the policy, it is growing at a certain rate. From what I've seen, it's about 3 to 5%. That is kind of
They're perfect.
the expected return or
Yeah.
growth rate. So at the same time, you're borrowing on that line of credit, and that line of credit rate will be anywhere between 4 and we'll say 6, depending on the policy and where rates are.
Yep.
But that was the one thing I really did overlook because I didn't realize that the actual cash value is growing at somewhere close to what the actual borrowing rate is. So that's why they say, when you're borrowing it, you're paying money back into the policy, which is also the company that you hold on to, that you own as well.
So what matters more, the rate or the volume?
The volume.
The volume of interest. So when we're talking about rate, so our money is growing at an increasing balance. And while we're paying interest on a loan, we're paying back on a decreasing balance. So it's not even like there's two different sides of the ledger. What we care about is the volume of interest. And Nelson said, hey, it's about the volume of interest that's paid in every payment and who collects it. So we can either pay it to an external financial institution and they get all the benefit, or we can pay it to the financial institution that we have actual ownership in.
Yep.
Right. And we get all the benefits of being the owner, right? Ownership has privileges. And so when we think about that, it's like just right on the surface is if I wanted a loan from the bank, I don't get to walk in and demand a loan. I say, well, that's a couple month process, 30 days of minimum, right? And I got to provide a blood sample for my firstborn, right?
Yeah.
And all those things. But when I want a loan from my insurance contract, I demand a loan. And if I want that money wired to me tomorrow, I can get it wired to me tomorrow. So ownership has privileges that I get the privilege of doing that. So I get something for all this. Do you have something you wanted to add in there?
Yeah, no, that's it. I think the next one is kind of goes right with it. And it's number 4, which think like a banker.
Yeah. Yeah. So most people there's 3 players in the play, right? Shakespeare said, if we understand the players in the play, we'll know what's going on. And so those of you that don't know those players, it's the depositor, the owner, and the borrower. And if you're not doing IBC, then you're 2 of those. In fact, it's actually worse because when you go borrow money from the bank, you're actually paying to borrow your money, right?
Yeah.
And Nelson talked about there's just one pool of money in the world. So, like, even if you make deposits at Chase Bank and then you went to Wells Fargo and took out a loan, guess what? You're paying to borrow your money. All right. And so we got to think like the owner. Like Nelson said, be in two businesses, be in the mobile home space and be in the banking business. Because if banking is the most important business in the world, why the heck would I not want to get involved in that?
Yeah.
So then I got to think like the owner instead of the customer. And that's why he did page 45 of his book. All right. So here's a little preview of page 45, because this is really what he wanted to drill down is he's got the CD sister and the IBC sister. Okay. So he just had this simple example. It was actually his wife's little Audi that is the example in there. And so he just $10,000, right? Take out a loan, pay it back every 4 years, going to buy another car. And at the end of the 50 years, keep in mind, you can compress all this, you can add zeros to these numbers, all of this. The CD sister just took the money out of her CD, interrupted her compounding constantly, and paid a little bit of interest and whatnot. But the IBC sister, this money kept compounding. And at the end of it, 50 years, the IBC sister has $706,000 more dollars in the account. Now, what the heck does that $706,000 represent? Represents interest. And who collected the interest? The CD sister paid all that interest to the bank and lost opportunity costs, and the IBC sister collected it all. So one was the customer, one was the owner. And it's just this incredibly simple little lesson. When I first read the book, probably the first 12 times I read the book, I didn't understand what Nelson was trying to tell me. And then one day I commandeered Jim and I said, explain this to me, please. And I think he probably said it to me a half dozen times before I had my light bulb moment. I was like, oh my gosh, why in the world would I ever want to be the customer of the bank anymore? The banker's making all the stinking money. And they don't make big volumes of money, right? It looks like just a little bit constantly over and over. It's like hitting little singles all the time. We're in a culture where we want to hit home runs all the time. That's not what the bank's doing.
Yeah. So like the first thing that comes to mind is if we just think as simple as a car loan. And generally when you stretch a car loan out, it would be actually your lowest payment that you can get.
Yeah.
If you go to like 72 months. But even at a 72-month payback period on a $30,000 loan, it's going to be close to $500 to $600 a month.
Okay.
And there's not many investments that you can take 30 grand and be able to get $600 of cash flow, even though some of it's principal and capital.
Sure.
So I always think of that, and it's the worst type of loan. I've never seen a good car loan structured. There's never been one. I mean, like the hardest one for me to get my mind wrapped around is like a 30-year mortgage, but at the same time, when you have the velocity of like
Yeah.
30 grand and you're paying yourself back 600, it's like you're going to accumulate cash a lot faster. And that's what I took it as, think like a bank, because you have velocity of money coming back and forth. Even if it's a 3-4%, it's still, you're getting what would have to be like a 24% return almost, because you're putting 30 out and getting 600 back.
Yeah.
So that's been the biggest thing is that's why they say it's the volume of interest. It doesn't come down to the actual interest rate. We're thinking about the amount of money that comes back to you regularly.
That's right. Yeah. And we can walk through those examples. I mean, there's so many great examples to help educate people about that. The rate is a distractor. It's like, is there really such thing as 0% interest when you buy a car?
No,
they just charge you more for the car up front.
Yeah.
Right.
That's because they can't sell them for the price they want.
That's right.
So then they give you a lower interest rate to get you to pay.
Yeah, they get it. All right. Like, so, all right. What's the last one?
It's rethink your thinking.
What the heck's that mean?
Got me.
All right. So let me ask you this. Do you know everything?
I don't know everything.
Are you willing to be 100% wrong?
I'm wrong often.
Yeah. So what I love is this posture. So Nelson even talks about it in the book. He sets up the problem, and a lot of people won't be able to overcome this problem, and he calls it arrival syndrome. And arrival syndrome is, I know everything there is to know. You can't teach me anything. And so that's why he said, hey, you have to be willing to rethink your thinking. And that's why he puts it at the beginning of the book, because if you can't rethink your thinking, then what's the point of even talking about the solution? If you think your money babysitter is the greatest thing since sliced bread, Dave Ramsey knows everything about money and by term invest the difference and pay cash for everything, and that's the cat's meow, and that is literally the gospel. Oh, and by the way, you're going to collect 10 to 12% in your good growth stock mutual fund. If you think all of that is in stone and it's non-negotiable, please turn off this podcast, delete the downloads in the future, forget this entire concept. But if maybe, no matter how much success you've had, you can still learn something new, then keep listening, right? Like dive in. I just had a guy on a meeting who was sold a policy about 5 years ago. This guy's a really successful real estate investor. He was putting 500 grand into a policy. Okay. And he realized that he bought it. It was constructed totally wrong. He was told a bunch of half truths. The guy who sold it to him had no idea what he was selling, and guy got lucky, honestly. And we were talking, and he goes, "Yeah, I've heard about this." And here's the long story short is this guy, when we talked for an hour and I walked him through things, and he was like, "Man, I got to tell you what, I've never seen any of this before. Like, this is totally different than this was talked to me before. This is what I wanted to get before." And here's a guy that after putting 500 grand into a policy in year one, and he got it all back even after the free look period because he had some receipts about things that were told to him that were not true. This guy could have been jaded about this entire concept about life insurance in general, like the whole shooting match. And this guy wound up going, "You know what? You've given me a lot to think about." He told our partner, Kyle, he's like, "Hey, I want a copy of that book that Nelson wrote. Like, I want to dive into this. I've got questions." And I had so much respect for that.
Yeah.
And it was my experience. When I came to this, I had done Dave Ramsey's Financial Noise, his Financial Peace course. And I was like totally hook, line, and sinker in that for a while. And then something just started poking at my belly. I was like, man, I think something's off here. I think this math doesn't add up. But Glenn, I don't know about you, but I'm just not that smart. I couldn't figure it out on my own. And somebody introduced me to Nelson's book, and I read that thing at a Denny's in San Juan on a layover while I was flying airplanes. And I went, holy cow, this is what I've been looking for. This is the unseen about money. I may not engage in this, but this is the rest of the story, as Paul Harvey would say, right? Like, I wanted to know it all the information so I can make the best decision. And I don't care if you're making $1 million a month or $1,000 a month. There's no chance you know all the things.
Mm-mm.
So it's this posture of, hey, I can continue to learn. And that's what Nelson is just imploring us to do, is just be willing to think about things a little differently. Things evolve, right? And I just really love that was, it almost should be lesson one, right? Because this is what he was really asking everyone to do, is be willing to be wrong. Like, have the courage and the humility to be wrong. And we tell people all this all the time. Hey, come read Nelson's book, read Make Bank Without the Bank, read Owner Shift, any of our stuff, watch our videos, and then come and try to disprove this. I'm willing to be wrong. Okay. Show me the data where we're wrong. Dave Ramsey put out a whole video about what a scam this is, and he doesn't address what we talk about almost at all.
Yeah.
It's a total joke, right? Like, because he can't get us on the merits of what it is, right? He doesn't have the courage to rethink his thinking. So that's why I've lost respect for that guy, right? He's telling people to do one thing, but he does another.
Yeah.
So, like, let's just have the posture and the humility to be incorrect and learn. I've learned a lot from you, Glenn. I learned from our clients that come to the table, from our prospects that ask great questions. Like, I love these dialogues. And I would just encourage everybody listening to just take that posture with all that you do and watch how it transforms your surroundings.
Yeah, definitely. And for myself, it's like, once you see it, you can't unsee it. And I can tell you that
Yeah.
in 2012, I looked at my first policy. I don't know if it was a good one or not, if it was a good company, what the story was, but I couldn't get my mind wrapped around it. And even once I got my first policy, I knew it was going to be okay, but I still wanted to poke holes through it. So I've read every book I can get my hands on. And the biggest thing is, I felt, after I really did my research, I felt so compelled that this is something that most people don't know about it. That's why I was like, I changed my whole podcast. I'm not changing my career as a real estate investor, but I see myself as, the reason why I started doing this was because I wanted to show other people, and I believe that it can change their lives as well. And I firmly
Yeah.
believe that. and it's all about education, and that's what this podcast is about. And I'm really excited to work with Nick and Jim. It's been kind of I have full faith that you and Jim are going to lead me the right direction. And if you guys are interested on jumping on a call with me and Nick, I have a Calendly link below. You can click the link. We can schedule a time. We can go over your 30-minute call and just go over your finances and we can see what we can do.
We have a no hassle guarantee.
Yep. This is not something to sell. This isn't a sale, because I can tell you that if you don't like it, you won't follow through. And that's not something we want. We don't want to do that. We want to show you how we run our finances. And if, following what I've done, I believe it's the best way to go.
Yeah. Awesome,
For
man.
sure.
I appreciate you, Glenn. Thanks for having me on.
Yeah. Thanks for being on, and looking forward to having you on the show many other times after this.
It's a pleasure, dude.
All right. Thank you.
All right. Bye.
Thank you for listening to the Capitalizing Your Life podcast. Please rate, like, subscribe, leave a comment, and share with someone who you think would enjoy listening.